Welcome, it's Denome. I got a really good question from one of my viewers, and the question is, how do I predict the future and how do I invest and manage my portfolio in a way that helps me avoid crashes and make money as best as possible? So basically, how do I buy the bottoms and how do I sell the tops? That's the question. And he's been watching my videos and he was a little bit unclear about this because especially lately I've been making videos during this time here just talking about the small moves there, but that's not really how I make money. I make money from the big moves here, and as an investor, that's in my opinion the easiest and the laziest way to make money. So that's basically what I do, and I just trade just a little bit here on these small moves just to keep myself entertained and to also hone my skills on trying to move these markets. But mostly I make money on these big moves, or try to make money in the big moves, and I try to save money in the big moves to the downside. So in this video, I will explain how do I see in the future, how can I predict the future and save myself money and make myself money as well. That's basically the idea of this video. And this video is, let's say, an add-on or a second part to a video I made before. So in the past, I made a video about my portfolio management. It should be up here right now. It's also in the description box. It's a free video. You can take a look at it. I explain how I manage my portfolio in the crypto space, in a bull market and in a bear market. So you can basically save yourself money as well as make money in the upside. Anyway, let's get to this video. So this video is mostly about predicting the future. How do I see the future? So the first thing you have to understand is I don't really predict the future. I visualize the future. So I kind of watch videos from YouTube about macro investing, about stocks, about crypto, about politics, and I take it all in, and then I try to visualize what the future is. And the big framework that I use is this one. So this is the market cycle framework. And as you can see from here, it starts with optimism, then enthusiasm, exuberance, euphoria, and then we are at the peak market condition. And this is when most people are bullish. Most people are like, yeah, this is just continue to go up. And this is the amount of highest level of financial risk. And then you start to see a little bit anxiety because it doesn't continue to go up. And then you see some denial. And this is usually the best time to exit the market, or at least manage your portfolio in a way that you take money off that asset that is in this part of the cycle. So then we go to fear, despair, panic, capitulation, and discouragement. This is when everybody has already sold who wants to exit the market. And people throw in the towel, they say, no more, I will never come back. This is it. It will never go up again. So I'm going to call it quits. I did not make money. I just lost money. So I'm not going to do that again. And this is usually when the big players also accumulate that asset class. And then finally, when the fundamentals change, the politics change, something changes, the asset starts to go up again. You see a little bit hope, relief, optimism, and then we see the hype cycle start again. So we have a hype cycle, and then we have this the selling cycle or bear market cycle. And that's basically how every market works. That's almost how every asset works. Yeah, that's basically how every kind of investing works, basically. And by the way, this is the amount of maximum fear, but it also has the maximum potential for the upside as well. So this is the key framework here. But it doesn't really always work like this. So markets are much more messier than it shows here. So for example, for Bitcoin, you can see we had a big downturn here, but then we had a rally to the upside again, and then we finally had the real bear market cycle here. So the markets always try to, screw you up, screw you over. So that's what happens in the real markets. But this is the framework that I use to analyze and predict the future. So let's actually take this into practice and talk about it, how I use it to analyze the world. So first off, you have to understand that there are different kinds of assets. So here are some common asset classes that I have listed here. So stocks, they are quite easy to understand. Let's draw the hype cycle here. like so. By the way, stocks, they over time they always continue to go up because of the money printing, because there's more and more currency units, so they don't usually go sideways like this. But just to visualize how this works, I draw it sideways. So in the long term, stocks always go up because of the money printing, but in the cycle terms, let's draw it sideways here. So stocks go up, they go down, and they move up and down like this. Anyway, let's talk about commodities then. So that's a blue color here. So usually in a normal market situation, the commodities have an inverse correlation with stocks. So when stocks go up, commodities go down. When commodities go up, usually stocks go down. And that's an inverse correlation. And we have actually seen this even this year, when the commodities have been going up, but the stocks have been crashing. So energy, as well as copper and some other assets, they have been going up. And this is usually what happens in a normal market. But of course, it's not always as clear and cut as this. If they were so predictable, this would be easy, right? So it's not like this, but this is the framework. So get that right. Anyway, then we have real estate. And real estate, if I draw it here, it will not look anything close to the real world, because real estate, it kind of does what it does. So it's not exactly related to either of these assets. So usually what I've experienced, this may not be true in all cases, but usually when stocks go down, real estate goes down, or if real estate goes down, then stocks follow. So I can draw it like this. But overall, the real estate usually doesn't go as low as stocks, and they don't go as high as stocks, but they just generally just keep tucking along the inflation route here. Sometimes you see bubbles in real estate, like for now, real estate has been coming down because of the interest rates. I will talk about that soon. But overall, this is just my analysis of this. Sometimes real estate goes down before the stocks, sometimes after the stocks. But anyway, they kind of go in the similar direction, because when real estate goes down, or let's say when the stocks go down, that usually means people have less money to invest. And because they have less money to invest, they can afford a cheaper house, or they cannot pay as much for the house. So that brings the prices of houses down to meet the demand, because the demand goes down when stocks go down. People don't have as much spare money to use when stocks go down. So that's one of the reasons why real estate usually goes down when stocks go down as well. Then we have bonds, and to be honest, I don't know that much about bonds, but it's an asset class that I've been recently starting to follow up again, but it's not an asset class that I actively trade, and I don't know too much about it. But I know it has an effect on the macro scale. I know a little bit about it, but I don't know enough to be confident enough to talk about it right now. So that's why I'm not gonna draw it here in this picture. Then you have risk assets, and risk assets, of course, they can be the crypto assets. They also can be stocks. So if you have some tech stock, I would consider that as a risk asset as well. And risk assets, this is my favorite color here. They actually correlate with the. Sorry, I already made a mistake here. Let's do it again. So real estate, it correlates when the stocks go down, right? So here we go. Not with the commodity cycle. It's with the real estate cycle. With the stock cycle most likely, at least on the downside. And well, you can make an argument that it inversely correlates with commodities as well, because when the commodities go up, that means it's more expensive to pay for a house. So the housing market, when the commodities go up, it should mean that the houses go up in price, but it also means that the affordability of houses goes down, because usually when commodities go up, energy goes up, living expenses go up when commodities are going up. So that's usually why also real estate goes down when commodities are going up. Just a brief explanation there. Then risk assets, finally. Let's go here. So let's take my favorite color here. So risk assets, they usually follow stocks also. But risk assets, they usually go higher than stocks and they go lower than stocks on the downturn here as well. So they follow stocks, but just bigger moves basically. So that's usually how so this is the framework that I do. So the markets, like I said, they don't follow it like this, not closely like this, but this is usually the framework how I view the world. So anyway, just talking about stocks real quick. You can have different kinds of stocks. So you can have the risk asset stocks, or you can have, like a very boring stock like a Walmart stock. It doesn't really do that much. Doesn't really it follows the markets, but you don't really capture the big moves here. But then you also can have stocks that let's say they mine gold, for example, or they are a coal mining stock. Then it doesn't really follow this cycle. It most likely follows the commodity cycle because it's in that sector. So stocks have a lot of overlap between other assets as well. So keep that in mind. But just as an overall framework, this is kind of what I'm expecting the world to look like. So this is the world how I see it. I follow these YouTubers, I follow news, I follow articles about all these things, and I try to map out the world. And then what I do is I imagine the world like this. Like this is the past, and this is where we are currently. So here we are right now, the markets are where they are. And then I try to take in all the information that I analyzed from here. And then I try to look at where the markets are headed. What's the political landscape? What's going on through this framework here? So then I imagine, okay, the future will likely be somewhere here. For example, don't be confused with the straight line. I'm just making a line here that this is the future where I'm expected to go. It doesn't mean it's go up or down. It's just the future where we are headed. So this is the future here. So then what I do is I try to imagine steps that are involved into getting to this future here. And then what I do also is, or let's say this is the most likely future. So this is the most likely future here. Then I imagine a future that is the opposite of the most likely future. What's an alternative future? Then I also imagine a few other futures that could happen as well. And then I kind of try to map out the plan how the future might unfold going there as well. And of course the future, let's say this does not happen this here, but this thing happens. Well, it doesn't mean that we just automatically go to this future here. It means that we might also go back to this future here, or it might go back to here. So the future is always in a constant motion. When I map something out, let's say 2 years in advance here, and then I think about, okay, 1 year from now or 6 months from now, what's the path to go there? It's in constant motion, so one thing happening or not happening doesn't rule out another thing happening later on, or the same thing happening later on. It's just something that I try to speculate on what's the likely scenario to happen. And when something happens, then of course I reevaluate the situation and sort of try to imagine a map like this again from that perspective, for example from here, how it will look like, what is the most likely scenario to happen. And then I manage my portfolio accordingly. And that's why I talked about the portfolio video that I made in the past. So in short, let's say, for example, this is the crypto market and you're only dealing with cash and you're dealing with crypto. At the top here, what I want to do, at least in the past, was I want to sell about 50% of my portfolio here. So I have 50% cash at the top here when I see too much enthusiasm, too much excitement. When the Dogecoin started to go up, when the NFT started to blow off, I'm like, okay, this is not gonna last too long. So I started making less videos and just tried to chill, and I took about 50% off. But now, like you saw in the video I made yesterday, I'm starting to get a little bit more bullish again. So that's why I'm probably making more videos now, and I'm getting a little bit more excited as well, because I think we may have seen the bottom here. I will talk about it soon. Actually, I'll talk about it now. So one of the indicators here that we may have bottomed is that the risk asset has come down. And by the way, risk assets usually come down before stocks, for example. So what we've seen here is that the Bitcoin had a huge crash, the altcoins had an even bigger crash, but the altcoins haven't been going down anymore, and Bitcoin has been going sideways. Some of the altcoins have already started to trend upwards, and what we've seen is the stock markets and the real estate markets have been continuing to go down, but Bitcoin is just going sideways. And right now we are already out of this this downward channel here. So this is a risk asset, by the way. And well, to be honest, Bitcoin is a risk asset, but it's also kind of like a commodity. So it has a little bit both qualities. But anyway, because stocks have already gone down, and the Bitcoin has already gone down, which is a risk asset, and altcoins have gone down, which are risk assets, but they haven't continued to go down. And stocks are, in my opinion, even looking like they might have slowed down or even stopped going down also. So that indicates that we might actually be near the bottom here. But I don't want to go all in. So at the bottom here, what I want to have is about 30 or 20% in cash in case we go further down, because you never know if a black swan event happens or if something happens, or just markets decide like, no, we want to go even more down. So you don't really, there's no guarantee that this is the bottom. They could continue to go down. Like I said, the markets want to screw you up over. So just looking at this right now, it seems like the markets have bottomed in this scenario, and the commodities have actually started to go down again. So in the last video that I made, you saw that the natural gas price has come down 50% already from the absolute top as well. So that's another indicator that we might be somewhere during this situation here right now. So that's what I consider the most likely future. But like I said, I want to have about 20 or 30% cash here because I'm hedging against these futures here as well, what I think are also likely. Like I've talked in the past that, maybe the Federal Reserve just continues to raise the interest rates and it just keeps raising it. And even if something breaks, it has other tools available to save those companies from going bankrupt, to save the banks from going bankrupt. But it's still possible that they just keep raising the interest rates to keep the dollar or the inflation lower. So that's another scenario that could happen. So I don't want to go too deep into risk assets because we could go down further. So that's why I hedge against these kind of futures here as well. So you start to kind of get the idea what I'm doing here as well. And then you also have to understand that you have these same cycles inside, for example, crypto. So sometimes what you can see is layer one solutions go up. You can see DeFi protocols themselves start to go off. You see meme coins go off. You see NFTs go off. So you have different sectors inside one single market that have similar lines like this. I'm not gonna confuse you too much on this video, but you have to understand that I have this macro framework, but I use the same framework inside an asset class also. So you understand a little bit how my mind works and how I try to map out things. For example, right now, if we just take a look at the live coin watch where I follow some of the crypto assets, what you can currently see is Dogecoin having 18% pump. So this is a good signal that maybe the retail investors are actually starting to come back again. And we saw some other assets like Matic just jump recently. It had like a 180% jump from the absolute bottom as well. And some other ones have also had huge pumps in the past. So maybe the retail investors are coming back. That's one of the things that I'm looking at as well. And then just what I want to also talk about is the overall macro situation, what affects these different things. So from stocks, what I mostly look for is the interest rates, because when the interest rates go up, it means that corporate loans are more expensive to upkeep. So you need more cash flow to pay for these interest rates. So if you have a stock which has a lot of debt or wants to have a lot of debt for investing, they have to reevaluate their cash flow and the future potential of that investment if interest rates are going up. So that's one thing. And another thing that I'm looking at is the PE ratio, which is the price per earnings ratio. So basically, what is the price of the stock compared to the earnings that they make per year? So if the PE ratio is high, it usually means that the stock is overvalued because it's not generating income as much as the stock is worth. So this is one indicator that a stock might be up here. But if the PE ratio is low, it's an indicator that the stock is here. And if the overall stock market has a high PE ratio in its stocks, it usually means we are up here as well. What I'm also looking at is FOMO. So FOMO is basically these feelings here: optimism, euphoria, enthusiasm, optimism, relief. So if you see a lot of retail investors in the market, that usually means that the stocks no longer have a lot of potential to go up, because most people who want to buy stocks are already into stocks. So when you see like in 2020, 2021, you saw the Wall Street bets happening. You see people celebrating Tesla so much and talking about Robinhood, how you can easily make money with it. That's usually a sign of FOMO. Now we have the opposite of FOMO. Not many people have been making videos lately, like me as well. Then you have to talk about growth potential. For example, Facebook has like 3 billion users already. So for them to double their user base, that's a little bit hard. So from that perspective, the growth potential is not there for Facebook. And Facebook recently went into the metaverse, but I don't really see metaverse as having a lot of impact in the near term. And right now, what we've seen in the news is that the metaverse is actually losing a lot of money, and it's not really working out as Mark Zuckerberg has envisioned. So the growth potential for Facebook, and by the way, advertising is going down because people are using less and less Facebook nowadays than before. So the growth potential for Facebook or Meta, it has some growth potential, but is it gonna 10x? Probably not. So usually in these situations, it might be near the top, but of course the stock price has already plummeted. So now it's a different story, right? Depending on the PE ratio and how they do things. But yeah, anyway, that's just something to consider. And there's not really a chart for it. You just have to kind of look into the company and into the potential, or into the market potential as well. And then commodities, what I consider affecting these prices is risk off situation. So when people want to take risk off from risky assets, usually they go into commodities, and politics have a huge impact on commodity prices as well. For example, recently we've had energy policy, we have had climate policies that impact the commodity and energy, and we have a war policy because the Russian sanctions have a huge impact on the energy market. So politics is a huge player in the commodity sector. And then real estate, wages is a big indicator. So you can take a look at real estate prices compared to actual wages. So what's the indicator called? I just forgot about it. Wages, real estate wage, I don't remember. But there's an index. You can Google it with real estate and wage index. Basically, those keywords you put in the Google and you can find it. So it just maps out how expensive is real estate compared to people's wages. So if real estate is expensive compared to wages, it usually means that the real estate might actually flip over because people cannot afford the real estate anymore. Interest rates has a huge impact on real estate. I could draw interest rates here as well, but it would get even more messier. So I'm not going to do that, and that would be in the bond sector also. So I'm not going to draw that here. Anyway, interest rates, when interest rates go up, it means you need more cash flow to pay for just the interest on the loan alone. So you need more money to pay for the real estate. So when interest rates go up, real estate goes down. So they also have an inverse correlation there. I think that's enough for real estate. Individually, depending on where you are in the world, if you're in a growth area, of course, real estate goes up. If you're in an area where people are leaving, real estate is most likely going to go down. But there's a lot of nuance here that I just don't want to get into in this video. Risk assets, FOMO is like one of the key indicators here, the memes, the hype. That's one of the key things here. Then innovation. Risk assets are usually tech stocks or crypto. Something with huge potential, and for crypto, for example, we don't really know the potential. But if you see a lot of innovation going on, and you see a lot of hype or interest in the future potential for that crypto or asset class, that's a huge driver for prices. So for tech stocks, for example, the PE ratio may be very, very high because they have a huge potential in their innovation. So that innovation has been priced in the stock, even though it's not reflected in the earnings. So sometimes you can see huge bubbles, like in the IT bubble in 2000s. People just had massive expectations, but those expectations weren't really real. So these two, FOMO and innovation, come in quite close-handed. But innovation is key. If you don't see a lot of innovation in the crypto space for a while, you can see the interest is starting to die down, and people are like, okay, it's done its thing. It did not revolutionize the markets, so I don't want to be in it anymore. So I want to exit. So that has a huge impact on risk assets. And risk on situation is also key. Risk on and purchasing power are very closely related. For example, in 2020, when the markets crashed and suddenly Trump came in with the Fed saying that we're going to print a bunch of money, we're going to give helicopter money to the people. Of course, the purchasing power of people just suddenly skyrocketed. Inflation expectations skyrocketed. So people, of course, were in a risk on situation. So risk on is heavily affected by policies and many other things as well. But overall, when purchasing power is going down, it means that people have less money to speculate, and they don't want to speculate because they are in fear mode. But when the purchasing power is going up, then suddenly people have the luxury to speculate on risk assets again. And if you are a retail investor and you don't have a lot of money, most people, they are looking for get rich quick schemes because they only have little capital, but they want to become a millionaire instantly. So risk on situation on when purchasing power is going up, that's when risk assets shine also. So that's a key indicator. There are many other indicators, but these are just some of the basic indicators for this framework, how I predict the future. By the way, if you watched all the way until this point, just want to remind you to watch the video about the portfolio management. In the future, or in the past, I said I want to have about 50% in cash in this scenario. In the future, I will probably want to have like 70% even in cash. So I could have downplayed or played this crash much better had I exited more of my money out of the crypto market. And also, if I had actually invested into commodities at this peak, that would have been great, right? But unfortunately, I did not really do that. So commodity market is also something that I'm currently looking into, and I set up the investment account already that I can actually invest into stocks that mine commodities. So I want to be even more, diversified in what I am able to do in the markets. So mostly currently I'm interested in the risk assets because in my opinion, we may have bottomed here. There's many indicators that we have already bottomed. So that's the most likely scenario here. But in the future, I would like to be in these commodity jumps as well, and not only just have cash and then sit 1 hour, 1 year, 2 years not doing anything. But just overall, for the hype, you can see this is the next BTC halving date, and for last time Bitcoin, it had this mid-cycle pump here, then it went down and sideways, and only after the Bitcoin halving date we had this big move to the upside. So we still have a few years, no, 1 year, 1 year until the next BTC halving date. So we still have time to make a new high here, and then a crash maybe, I don't know, or maybe like anything can happen really. But what I'm expecting it is to go sideways or up. I'm not really expecting it to go down. That's why I'm currently putting more and more money into assets again. Yesterday, I think I bought Matic. Yeah, I bought Matic, and I started to play with Uniswap. Uniswap, what is it? Liquidity providing once again. So I'm getting back into crypto, into risk assets, because sideways or up, I'm very fine with those odds. Like if we go sideways, I can make money from the liquidity providing from yield farming. If we go down, that's a risk, but that's why I have 30% in cash reserves ready to buy those dips as well. So anyway, that's basically the framework here. Let me know in the comments if I explained anything or explained this framework in a clear way. If you have some questions, I will probably answer you in the questions, or if it's a really good question that brings up a new point, I might make a video about it also. So anyway, that's it for this video. Hope you liked it. Consider subscribing for more content like this one, and I will see you in the next video.